Hello and welcome everybody to BUS414 Globalization and Business. My name is Roland, and in our second session for Globalization in Business, I will talk about the distribution of labor and resources. Now, of course, this is important when we are talking about how globalization and business work with each other. We need to understand the economic foundations of trade and prosperity. Now, a lot of this will be a bit repetitive for you because you have already done economic sessions, but the first thing is that we need to get the basics right. And that is why I want to start looking at how does trade work in a one production factor world, look at the Ricardian model again. Then I want to start mobilizing these production factors and look at the specific factors model. And finally, I want to look at different trade models and how multinational corporations make decisions and how trade policy can affect that. Let's get started. Now, when we talk about the economic foundations and resource bases, we are looking at first the individual level of person and country, which is both a micro and a macroeconomic question. And in both equations, we are looking at that consumption and, of course, production is constrained by resources, which means we do not have all the resources in the world available to ourselves. So we are limited in what we can produce and what we can therefore consume. Imagining there is no trade, but as we will soon see, trade has always been around. Now, and trade means that we start exchanging goods with one another on either an individual basis, corporate basis, or on a country-to-country basis. Obviously, the actors are not necessarily countries, but individuals and companies. Now, what that does is that it increases our choice beyond the limits of our own production and resource capacity. And the results of understanding that this is happening is obviously trade. The division of labor is rooted in this principle, and of course also labor specializations. It is important to understand that trade has always existed. When we go back to the Neanderthalers, or even further back when we lived in caves, we quickly realized that well, the people in the other cave outside there next to us, they have nice things too. And it is better for us if we don't go to their cave, knock something over their head and steal their stuff. We can only do that one time. It is better if we go to them and say, we give you this, you give us that, and start trading things that we need. So humans or early humans got together in bigger numbers beyond the immediate family and created tribes, for example, or villages, cities, and so on, and started specializing themselves in doing things. Not everybody went hunting, not everybody was looking for vegetables, not everybody was looking after the old and the young members of the tribe. And really crucial to the success of humankind was that we managed, or early humans managed, to trade beyond their immediate surroundings. And for example, in Horan et al., it is described that Neanderthalers had an advantage over other humanoids because they had long-range trade routes. So, for example, Neanderthalers in one valley of the continent traded with Neanderthalers on the other side of the continent in their valley, and therefore had a wider access to goods and later on services than those humanoids that did not trade over longer distances. For example, when a local catastrophe happens, a drought, a flood or something, that is very bad for that particular patch of land, but it does not preclude that you are trading with some people that are not affected by this because they live further away. So trade has always existed. It is not a modern times phenomenon, and it has been very good for our survival. The second thing we need to look at is, yes, trade increases consumer choice. And I'm sharing with you data from 2015, how exports and imports in the US have developed as a function of total national income. And we can see the share of export and imports, the share of trade within the national income has constantly risen from 5% and below to almost 20%. So we can see this is very important, and a very important part of our national income, our own income. And by expanding our trade, we give consumers more choices to consume, and thus it can raise living standards. But if trade is so good, the question comes up, why does it not work for you and me? And in the following session, we are going to look at a potential answer. For now, I want to look at the Ricardian model, where we have one production factor, namely labor, in a very basic model invented by developed by David Ricardo in 1817, so it's also quite old. And we say we cannot move the production factors from A to B. We can move them in our own country between industries, but not across countries. And this is where a phenomenon called comparative advantage was discovered. Imagine there is two countries, domestic, that is us, and foreign, our potential trade partner. We can have free trade, but for now we have chosen to produce everything that we consume ourselves. And let us imagine there is two goods, flowers and computers. We can choose any two good combination, but it is important that both countries have a fixed amount of labor that cannot move between countries and capital that cannot move between countries. Now, with our labor and capital domestically, we can produce 10 million flowers or 100,000 computers. The foreign country, our potential trade partner, can produce 10 million flowers or 10,000 computers. So we can see we can produce more computers and we can produce the same amount of flowers. When we go further, we need to look at the concept of opportunity cost. For every computer we produce domestically, we cannot produce a certain amount of flowers. And the same thing with our trade partner, the foreign country. The consequence of that is, when we are drawing a production function, the red line being our domestic production function, the blue line being the foreign production function, we can only choose production that is on that line or left and under of it. We cannot choose other production mixes. Now, why would we choose to produce below our capacity? For now, we will assume that we are producing exactly at our production capacity, which is called the production frontier. And you can see the production curve of the foreign country is very steep, which means they have very high opportunity cost for building computers. The domestic production frontier is much flatter comparatively, so we have lower opportunity cost for producing computers. You can also see the flower production possibility is 10 million each, so we have the same capacity in one good and different capacity in another. Now this is coincidental, but the example works much better if we have that point. Now what happens if we combine our production capacity? Well, we can choose now between 20 million flowers and 110,000 computers. The new golden or green golden production frontier curve is what we can produce and consume now. And that is an expansion for both the foreign and the domestic country. Now in this overview you can see it much clearer that the combined production frontier on the most right-hand side is the largest production and consumption possibility that we have. So we can immediately conclude, yes, for both our countries it is good if we trade with each other because we have more goods. Now obviously there is now a thing between what do we do exactly and which country produces what to what extent. And in this example, since the opportunity cost for building computers are extraordinarily high between us and the foreign country combined, the domestic country will focus on computers and the foreign country will focus on flowers. Now, what is the problems of that? The problem is that, first of all, production factors are not equal, and the Ricardian model assumes they are. So, for example, land is finite. You cannot create more land out of thin air. Land is what it is. Labor is constrained. Yeah, you can't work more than 24 hours. You can't work more and harder than you do. The other thing is that capital is theoretically unlimited. So there is an advantage in capital-intensive production, and there is an extreme disadvantage for land and labor-constrained production. So the second problem that we encounter in any kind of trade model actually is that there is not always constant return on investment. There is a law of diminishing returns. And what does that mean? So if you add another unit of labor to the production function, this labor unit is not as productive as the previous unit that you have added. And so in practice, you will see that production, with increasing the level of resources that you are adding to the production, starts to become flatter and flatter. And that will result in we are only adding as much labor or production factors to the process that are still able to give us a positive return on that investment. So for example, if the final labor unit we are adding is producing 10 units worth of money, because that is the medium we are going to compare it to, but it is costing us 11 units, but it is leading to a negative return because it costs much more than it produces, then we are not going to add that. What we want is a positive return on the investment of that labor, which means the labor still needs to produce more than it costs. Another issue is that trade policy can alter this equation dramatically. For example, there is subsidies, there is quotas, there's tariffs, and a lot of other issues that can happen in international trade policy. Particularly, factor mobility can be altered just as I want it. For example, labor. I can attract foreign labor by saying you don't need a visa to come here. You can work here immediately. We don't care. Yeah, as long as you pay taxes, you can work here. That is an immigration policy. You can also set the standard of immigration or the visa requirements very, very high. The UK, for example, has a very high level of visa requirements. For example, you can only come here to work as, for example, an entrepreneur if you make over a certain amount of money. Anyone that would make below that amount of money will not get a visa. End of the discussion. Now, whichever is better depends on the domestic situation. For example, if the United Kingdom wanted to attract cheap labor from abroad, it would lower these standards. And we, after Brexit in particular, we have an issue that food is rotting in the fields because no one wants to do that job. Well, the response was that workers will get a temporary visa for X amount of months and then they go back, which has not been very successful, all things considered. Now, in reality, the Ricardian model does take wages and productivity in account. I need to forewarn you that. And the production choices that are being made are made to maximize production value within the constraints of our efficiency, within the constraints of our availability and ability, with fixed production factors. Now, there is obviously more models than that, and in the specific factors model that was developed by Paul Samuelson and Ronald Jones, we assume that there are two goods with specific production factors, but we allow labor to move freely between those goods. Now, the goods can be traded, the production factors cannot be traded. What that does, it allows for a temporary structural misallocation and the transition of production factors between goods, and it allows for the concept of income distribution. Obviously, if I as a worker can make more money in another industry, I will change that industry if I can. That is one of the big issues nowadays, because people with a low level of qualification have increasingly fewer choices of employment. Now, what happens if we allow for if we are looking at these models and allow for this flow? Production factors will move towards the optimal value, which means the optimal mix between production factors in order to maximize output and minimize the cost. The factor equilibrium after trade depends on how mobile is that factor, and obviously also the marginal product of labor in the accepting sector. Again, as an example, this is how mobile are you as a worker? What skills do you have in the new economic equilibrium? For example, if you are going back to the example that I made with the post-Brexit economy in the UK, if you are a European worker working here picking fruit, which was one of the seasonal employments here, and your skill is limited to picking fruit, then no, you cannot change your job. But if you are, for example, a skilled IT person, and in your home country you're not being paid very well, you can make more as a fruit picker here in the UK, then you have the choice between a poorly paid IT person in your home country or a highly paid fruit picker in a foreign country. And people will optimize their return on investment, and their investment is labor, obviously. So this creates a global workflow restricted by immigration policy, but also a transnational, transitional, temporary distortion before we can establish a new equilibrium. Because if that person comes from a foreign country to the UK to be a fruit picker, they can't be a fruit picker or an IT person in their domestic country. One of the situations what this has led to in the European Union is that a lot of plumbers here in the UK are from Poland. They're doing a great job, and they have this opportunity because very few people here in the UK want to be plumbers. Yeah, dirty job, long hours, and the pay does not reflect for some people here what they have to do. Now this has led to a plumber shortage in Poland. Yeah, if all the plumbers are here in the UK, they can't be in Poland. So what has happened is Poland has now recruited or has been recruiting plumbers from, for example, Vietnam. Now you will be saying, okay, why Vietnam? There is a historic example. For example, a lot of people that have foreign labor experience from periods before the 1980s were from Vietnam, and they were invited to work for a certain period of time outside of Vietnam, for example, in Poland, in East Germany, and over all the Eastern European countries, because they were communist and Vietnam was communist. So they allowed the Vietnamese population to go abroad for a while, make a lot of money abroad, come back and spend the money there. Now, in reality, we have limited mobility. Yeah, we cannot immediately move the sector. We cannot immediately learn and employ a new skill. For example, if the new skill that you need is computer programming, it will take a while for you to learn computer programming. The mobility of resources, if you want to move to another country, it will cost you time and it will cost you money. So the question is it really worth it? And the new market, the new country needs to make it attractive for you to come and work. And one of the things that we need to recognize is that the market and the competition between market players is not perfect. There is a distortion of power, or there was for the last 20-30 years, a distortion of power towards the employer, and that is changing these days post-COVID. We will be talking about this in a later session, but for now, markets are not perfect. They have distortions to one side or another. Now what happens if we start trading? Number one, economic competition happens now across borders. Not only between you and me as individuals, but also between companies, firms in the same business sector. For example, if we have completely free trade between Nigeria and the United Kingdom, then, for example, universities are competing with one another. Or if we have a car industry, there is actually a very good car industry in Africa, then African car makers are competing with European car makers. So what are we doing about it? Are we adding additional distortions? Are we allowing for gradual adjustment? Or are we coming down hard and say free trade now, which will disadvantage a lot of people in both countries? Now, what this has led to, and what Western countries have only realized over the last 2 or 3 years, is that this equation and free trade also leads to a competition between countries and political systems. Currently, the Western world versus the world view of the Eastern, it's in particular Chinese political system. Now, obviously, this is not a new thing. We have seen things like that before, and we have looked at other, even more sophisticated trade models. And I want to talk mostly about multinational corporations, how they make decisions and how trade policy affects that. So, for example, there's the Heckscher-Ohlin model with increased levels of detail. And when we start employing more and more sophisticated models, we can explain and predict international trade patterns and how goods will move from one country to another. However, what we can't do plainly on the model, what we can only analyze and make reasonable inference from incomplete data, is the domestic, social and political consequences. Now, for example, over the course of the Cold War, the Soviet Union spent an increasing percentage of their revenue, of their money, on weapons, and people realized more and more through exchanges with the Western world, well, these people have the same amount of weapons, but they also have refrigerators, they have cars, they go on holidays. We want that too. Now, what is happening, and one of the reasons perhaps why there is an increasing decoupling between China and the rest of the world, is that since the 1980s and particularly the early 2000s, Chinese people were able to go out of China. They were able to see all these things that are going on in the rest of the world, and they are saying, well, we are doing the same things, we want the same rewards, we want, for example, refrigerators, we want cars, we want holidays, we want this. And obviously that is always a challenge to the political system, not only in China, but in any kind of country. When you see that another country has something that you don't have or you are not allowed to have, then the question comes up, well, why is that the case? And that is a reason for domestic, social and political change. Now, how we steer this kind of trade and how we try to maximize benefit for us domestically is trade policy. So we want to affect, as politicians, the domestic trade equilibrium. We want to protect our workers while taking advantage of global trade. So we cannot control what everybody else does in the world, and that is a big issue, obviously, for policy. When you look at the book by Danny Roderick, our course book, you will see there is a lot of conflict between the three pillars of the world that he is introducing. For example, democratic society domestically, international trade, and there is limitations to what you can do. So you can look at the tools of the trade or tools of protectionism, product specifically, or as voluntary export restraints. Now, how does this work? When you have an import tariff, you are adding additional cost to the price of an imported good at the point of entry. For example, when the ship comes into the harbor, the goods are offloaded, and then you say, okay, this does not cost 100 currency units plus transportation, but I'm adding another fee on top of that, which makes these imports more expensive for the importer and thus the buyer. Because the importer won't pay for that, you as a potential buyer are going to pay a higher price for that product now. Now you can also go to via the route of import quotas, which means only a limited amount of goods can be imported in any given year. For example, we only allow 10,000 computers to be imported into our country. The idea is that you want to protect the domestic producers. However, as a consequence, the product becomes more scarce and thus more expensive, whether it is imported or not. So when you see, okay, only 10,000 computers are allowed to be imported, only 10,000 are produced domestically, there's only 20,000 computers, but we need 30,000, these computers will become more expensive. Meaning an import quota also benefits the foreign producer. Now you can also incentivize exports. So when you say every unit of good that is exported will not pay this kind of tax, or will be so, or can be sold for a lower price, then you are making it more attractive for the company to send that good abroad, because they can still charge the same price. What that does, it channels production into export-oriented industry sectors rather than consumption or domestic consumption-oriented production sectors. You can also go the other way around and say we are voluntarily not exporting as much as we could. And that works like a reverse quota. You're saying only 10,000 computers will be exported in any given years. That makes your good, especially if it's a high value good, much more valuable, and allows the exporter to charge a higher price. More money comes into the country, and more taxes will be paid to the domestic revenue. Now you can also go a completely different route and say you want to specify how products are supposed to look and work. This is one of the things the EU has been doing on a very large scale. For example, using electrical safety regulations as a limitation for what can be sold in the domestic market. So everyone who wants to sell electric appliances in the European Union is now forced to comply with these standards, or we are not allowing you to sell it. Simple as that. So what that does, it creates an imperative for the exporter to modify either the product or develop a whole new production line, which is more costly for them, doesn't do anything in the domestic market, but as a consequence makes it more expensive for an exporter to comply, makes the product relatively more expensive, and sort of dilutes any other advantage that they may have. Now, as a brief summary about this trade idea, the models enable us to describe trade and to draw conclusions and predict value streams. However, prosperity is not an automatic result of trade. We have not talked about prosperity at all, particularly if one group of people benefits, whether domestically or foreign. That does not mean these prosperity gains, these limited prosperity gains, are shared equally or shared at all with the general population. Particular interest can influence trade patterns. Now that means that certain industries that are very powerful, for example the car industry in Germany is very powerful, can influence politics, then receive beneficial treatment, and thus influence trade patterns. And where business and politics interact, the results of these interactions leads to changes in societies domestically and abroad. The concept of trade is based or is influenced on external factors in an otherwise closed loop system. For example, when we look at society, business, and politics, we have a closed system within our country, but as soon as we open up to trade, society, business, and politics is influenced by the existence of foreign trade coming into our country and domestic goods going out of our country. This significantly or can significantly alter the balance of trade of society, business, and politics. Society, business, and politics operate and interact with one another, which is a delicate balance in the absence of trade, but even more volatile when external influences are coming into consideration. Now, a lot of things are being said of, we don't want external influence. The logical consequence of that is then you can't have trade. You need to build a wall around your country, not let anyone in and not let anyone out. That is an extremely unrealistic assumption. Not going to happen. No matter how hard you try, this will not happen for any given country. Specifically, I need to make you aware of that any country in the history of humankind that has ever tried to separate itself and its economy from the world economy has failed. No discussion. Automatically it will happen. No country in the world can be separate from the rest of the world. However, trade and what happens through trade needs political regulation in order to protect politics and society. Obviously, when you have external influence, and you have that automatically when you are trading internationally, this will affect domestic politics and domestic society. So there needs to be a consensus, because you yourself, the domestic country, cannot significantly influence the global consensus and the global equilibrium. There needs to be a global consensus of how stuff works, how we interact with one another, and the kind of actions that are prohibited. Now, system shocks happen when one factor starts to alter the status quo. For example, one country that has a significant influence on global trade decides, we are no longer trading with you, or we are only allowing certain goods into our country that fulfill certain specifications. And what then happens is that there will, through evolution, be a new but equally volatile balance of factors leading to a new economic equilibrium at the global level. Now, as a business, I want as little regulation as possible. I am looking out for my own benefit, which means I want more money. And as a business only focusing on the financial gain, my interest in the politics is limited to my benefit, and the limit of interest I have in society is these people should buy from me. So as a business, I want to make money. I don't care who is the politician as long as they let me make money. And I don't care who society is as long as they buy from me and allow me to make money. Now, as a politician, I want domestic social stability, and thus I keep in power. So I need to look at how can I balance the interest of business and society in the situation where global trade is happening. Now, as a society, as human beings, we want stability so we can plan our future. We want prosperity. We don't want to be poor. And our desire in these things is potentially undermining business and trade, because business has no interest in us other than we give them money, and trade can undermine our position, our societal stability, our outlook at prosperity, and that is why there is a balance between politics, society, and business, or there should be. Now, if we want prosperity all around, there will be continuous adjustment and fine-tuning. And we need to regulate trade and the traders. We need to do this on an international level, because if we are the only ones that are introducing regulation, then business will simply go somewhere else. However, the most important thing in this whole equation is that the rules we internationally agree on need to be enforced. If any player, whether it's a country, an organization, or an individual, breaks the rules, they need to be punished for breaking the rules. If they don't get punished, other people see, well, why is this person, why is this company, why is this country not being punished for doing bad things against what we agreed on? And this will lead to an increasing number of individuals, companies, and countries behaving in a bad way. So without enforcement, rules don't mean anything. So I want to close today, and in the next session I want to talk about a brief history of imperialism, because globalization is, when we look at its history, also a history of countries exercising global power through force. Thank you very much for your attention. Please have a look at our sources and talk to you soon.